In 2008, hundreds of banks failed and millions of people discovered too late that the system they trusted was far more fragile than they believed. What's forming now isn't a repeat of that moment, but an evolution of it. The conditions lining up toward 2026 make the last crisis look more like a warning shot than the main event. If your savings are sitting quietly in a bank account, untouched and unquestioned, this is something you need to understand before panic replaces calm. It's easy to dismiss warnings like this. People have been predicting crashes for years, and most of the time life goes on. Markets wobble, headlines fade, and the system limps forward. But this situation is fundamentally different because the damage isn't hypothetical or future tense. Much of it has already happened. The losses already exist. The stress is already built into the system. What's left is simply the moment when it becomes impossible to hide. The year 2026 matters, not because of superstition or prophecy, but because of timing. Several powerful forces are converging at once, each dangerous on its own, but potentially devastating together. When you see how these forces interact, it becomes clear why major investors and institutions are quietly repositioning while the public remains largely unaware. One of the biggest pressure points is commercial real estate. Trillions of dollars in loans tied to office buildings, shopping centers, and large commercial properties are scheduled to mature over the next couple of years. These loans were written in a very different world. Interest rates were near zero. Office buildings were full. Retail spaces were busy. Property values were inflated by cheap money and optimism. That environment no longer exists. Remote work has permanently reduced demand for office space in many cities. Online shopping has hollowed out brick-and-mortar retail. Entire buildings now sit half-empty, sometimes nearly abandoned, while their debt remains very real. Property owners are being forced to refinance loans at interest rates 2, 3, or even 4 times higher than before, often on properties worth far less than they were just a few years ago. When a building that once justified a massive loan suddenly loses much of its value, the math stops working. Owners walk away, loans default, and the institutions left holding that debt are often not the largest banks you hear about every day. The biggest banks saw this shift coming early and reduced their exposure. Smaller and regional banks did not. Many of them are now heavily concentrated in commercial real estate loans that are quietly turning toxic. At the same time, another problem has been growing in plain sight, hidden by accounting rules most people never hear about. Banks hold large portfolios of government bonds and mortgage-backed securities. These are typically considered safe assets, but their market value moves in the opposite direction of interest rates. When rates rise sharply, the value of existing bonds falls. Over the past few years, rates rose faster than they had in decades. As a result, banks across the system are sitting on enormous paper losses in their bond portfolios. These losses are very real, but under current rules, they don't have to be fully recognized unless the bank is forced to sell those assets. On paper, everything looks fine. In reality, hundreds of billions of dollars in value have already evaporated. This becomes dangerous when confidence cracks. If depositors begin pulling money out, banks may be forced to sell those bonds at a loss to raise cash. Losses that were once hidden suddenly become fatal. This exact dynamic played out in recent bank failures, where institutions collapsed not over years, but over days. What makes this especially concerning is that these bond losses are concentrated in the same regional banks that are heavily exposed to commercial real estate. They're being squeezed from both sides at once. Falling property values weaken their loan books, while rising interest rates hollow out their investment portfolios. It doesn't take much stress for that combination to become unbearable. Layered on top of this is a third risk that rarely makes headlines, but quietly connects the entire financial system together. The global derivatives market is enormous, dwarfing the size of the real economy. These contracts are essentially bets layered on top of other bets, often tied to interest rates, asset prices, and credit conditions. When everything is stable, these instruments appear harmless. When volatility rises, they amplify stress dramatically. Many of these contracts are interconnected, meaning trouble in one institution can rapidly spread to others. A missed payment in one corner of the system can cascade outward, creating chain reactions that are extremely difficult to stop once they begin. The most concerning part is that many of these derivative exposures are linked to the same factors already under strain: interest rates and real estate values. If defaults rise and rates stay elevated, the risk doesn't stay isolated. It spreads through counterparties, creating uncertainty about who owes what to whom, and whether those obligations can be honored. There is a common belief that reforms after the last crisis made this kind of systemic failure impossible. Regulations were tightened, safeguards were promised. But over time, many of those rules were softened or rolled back, particularly for smaller institutions. The largest banks faced the strictest oversight. The regional banks most exposed to these risks often do not. Quietly, the institutions meant to protect depositors have been preparing. Insurance funds have been reinforced. Emergency lending facilities have been kept active long after their original purpose ended. These are not signs of confidence. They are signs of anticipation. Systems don't quietly prepare for storms they believe will never arrive. At the same time, those closest to the data are behaving in telling ways. Bank executives and insiders have been reducing their personal exposure, selling shares, and limiting risk. These are not emotional decisions. They are calculated moves made by people with access to information most depositors never see. The authorities face an uncomfortable dilemma: allow widespread bank failures and risk a systemic collapse that freezes credit and crushes the economy. Intervene aggressively and risk igniting inflation by flooding the system with newly created money. Historically, when forced to choose, policymakers lean toward inflation. It's quieter, it spreads the cost across society, and it avoids immediate collapse, even if it erodes savings over time. When money is created to stabilize banks, the value of existing money declines. Savings accounts may look unchanged on paper, but their purchasing power shrinks. Prices rise, living costs climb. People feel poorer, even though their balances haven't moved. This is how crises are often resolved, without dramatic headlines, but with lasting consequences. Understanding where risk concentrates is critical. Banks with large exposure to commercial real estate, high levels of uninsured deposits, and significant unrealized losses are more vulnerable than most people realize. Uninsured deposits, particularly those above official limits, tend to flee first at any sign of trouble. Once withdrawals accelerate, even healthy institutions can fail due to the simple mechanics of banking. The most practical defense begins with awareness. Knowing how deposit insurance works, and where its limits lie, is essential. Concentrating too much money in one institution creates unnecessary exposure. Spreading funds across multiple, unrelated banks reduces the chance that a single failure disrupts everything. Beyond that, it's worth considering assets that don't rely entirely on the banking system. Historically, tangible assets like precious metals have served as stores of value during periods of monetary instability. They don't depend on promises or counterparties. Their value doesn't disappear because the balance sheet weakens. Short-term government securities are another option many overlook. While no asset is without risk, these instruments are structured differently from bank deposits and don't rely on the solvency of a single regional institution. Holding them directly or through conservative funds can reduce exposure to bank-specific stress. Keeping a modest amount of physical cash is not about fear, but continuity. During financial disruptions, access matters as much as ownership. Even temporary freezes in payment systems can cause real-world problems. A small buffer can bridge short disruptions without panic. Some people also look beyond domestic borders, recognizing that concentration in a single financial system carries its own risks. Diversification isn't about abandoning confidence, but about reducing dependence on any one structure behaving perfectly under stress. Others explore decentralized digital assets as a hedge against institutional failure. These assets carry volatility and require careful handling, but they also operate outside traditional banking rails. For some, a limited allocation serves as insurance rather than speculation. Preparation isn't about predicting the exact date or trigger of a crisis. It's about positioning so that no single failure can upend your entire financial life. History shows that crises rarely announce themselves clearly. They begin quietly, accelerate suddenly, and are explained only after the fact. The early signals usually look small. A troubled bank here, an emergency announcement there. Reassuring words, paired with extraordinary actions. Those moments are when speed and clarity matter most. Acting early is often the difference between inconvenience and real loss. Even if the worst scenarios never fully materialize, the cost of preparation is relatively low. Diversification, prudence, and awareness rarely harm anyone. The cost of ignoring risk, on the other hand, can be devastating when confidence finally breaks. Financial systems don't fail overnight without warning. They weaken gradually, masked by complexity and optimism. The patterns that preceded past crises are visible again today. Excessive debt, inflated asset prices, rapid rate changes, and hidden losses. The only uncertainty is timing. Using the time available now, while systems are still functioning smoothly, offers options that disappear once stress becomes visible. Waiting until everyone else moves usually means moving too late. This isn't about fear or panic. It's about responsibility, understanding the system you rely on, recognizing its vulnerabilities, and taking reasonable steps to protect yourself and your family. Those who prepare early rarely regret it. Those who don't often wish they had. Whatever happens in the coming years, being informed and positioned gives you control, in a world where many will feel they have none. That alone is worth the effort. Hey everyone, if you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin, and don't forget to hit that bell icon so you never miss our latest videos.